My first thought was that the report that came out this morning is pretty much in line with our expectations. Our hand is a steady hand in this. We've been saying all through last year and this year that we're making progress. We've noted that progress. We haven't overreacted to it. We didn't overreact to the good data we had in the second half of last year. You heard us saying that this is good, but we need to see more. And you won't hear us overreacting to these 2 months that are higher. The reason that's important is that the decision to begin to reduce rates is a very, very important one because the risks are two-sided. If we reduce rates too soon, there's a chance that inflation would pop back and we'd have to come back in, and that would be very disruptive. That would not be a good thing for the economy. There's also a risk that we would wait too long, and we would in that case it could be unnecessary, unneeded damage to the economy and perhaps the labor market. The economy is strong. We see very strong growth. We had growth for last year over 3%. Many forecasters see growth coming down to around 2% this year. That's about roughly what the first quarter looks like. That means that we don't need to be in a hurry to cut. It means we can wait and become more confident that, in fact, inflation is coming down to 2% on a sustainable basis. My own expectation is I don't think rates will go back down to the very, very low levels they were at before the pandemic. But where they will turn out to settle out, it's hard to say. This economy doesn't feel like it's suffering from the current level of rates, although if you look at things like inflation-sensitive spending, then those parts of the economy are really feeling the high rates. So now we have, it's been surprising over and over again. So I think we have to be unusually humble about our ability to foresee the future and be ready for different plausible outcomes.
I've told you this story, I think, last time you and I spoke about a conversation I had with then civilian Yellen. It was between her time as chair and Treasury Secretary, and I asked her why the Fed hadn't been able to get inflation up to where she wanted it to be, where the committee wanted it to be, and she literally looked at me and went, "I don't know." And I guess my question is would it be a bad thing for you to say, "We don't know. We're doing the best we can"?
We say that all the time in one way or another. I'll give you an example. We have, as I mentioned, high inflation in January, somewhat less high inflation in February, and we've been saying that we expect inflation to move down to 2%, but on a path that is sometimes bumpy. So the question then is, are those just bumps, or are they something more than bumps? Is progress on inflation going to slow for more than 2 months? And that's a question, and honestly, we're just going to have to let the data tell us that. There isn't anybody who knows, and so our position is we don't know. We'll tell you what we will do if inflation does come down, and that's sort of the base case. That is what we expect. We expect inflation to come down on a sometimes bumpy path to 2%. But if that doesn't happen, then obviously our rate policy will be different. And for example, we can hold rates where they are for longer, and that's what we would do, of course, if inflation doesn't come down, if we don't see the progress we're looking at. So we kind of say that all the time. This is one of the things. We've had our policy rate at 5.3%, which is the highest rate in more than 2 decades for some time, and all through the course of 2023, we saw very strong growth. So it's and that's partly because this has happened in a context of supply side healing, which makes its own growth, when potential output goes up. So we don't really know where rates are going to go back to when this whole thing is over. For many years, if you go back to before the global financial crisis, it wasn't unusual to see the longer term rates in the 4s. And so, are we going to go back to whereas in the sort of time between the global financial crisis and the pandemic, rates went lower and lower and lower, and it wasn't unusual to see in other countries long-term rates below zero, even. Mm-hmm. Europe. They never went that low in the United States, but they went very low. So are they going to go back up to those higher levels of the pre-global financial crisis? We really don't know. We think that the factors that led rates that really came down over a 40-year period, mostly related to big, slow-moving things like demographics, aging population, which saves more, and productivity, low productivity, and things like that. Those things don't jump around. They're sort of slow-moving objects. But the truth is we don't know. My own expectation is I don't think rates will go back down to the very, very low levels they were at before the pandemic. But where they will turn out to settle out, it's hard to say. This economy doesn't feel like it's suffering from the current level of rates. Although, if you look at things like inflation-sensitive spending, then those parts of the economy are really feeling the high rates. Maximum employment, and price stability. And when one of those mandates is far from its goal, then and the other one isn't, you focus on the one that's far from its goal, and that's actually in our document that codifies the way our framework. So that was the case from the late 2021 until inflation started coming down, and so we focused very hard on inflation. And you heard us talking about inflation, but headline inflation just a year ago was I guess 5.2% on a 12-month basis. Now it's 2.5%, and core I think has come down from 4.8 to 2.8. So you've seen really significant progress. Just as a natural thing, then the work's not done. Our goal is 2%. But as that happens, the risks to the two goals come into better balance. They're coming into better balance. And that means we are a dual mandate bank under law. That means that we now that thing we were doing, we were just thinking about inflation, that's no longer appropriate. So we're thinking about both. We're thinking about the risks to both now, and we should be. That's our job under the law. And so we're very committed to getting inflation down to 2%. Having it down to 2% is critical if we're going to have the kind of long expansions that really benefit all Americans in the workplace. At the same time, if we were to see unexpected weakness in the labor market, then that's something that we would be looking at carefully and could draw a response as well.
A policy response, clearly.
Yes.
Yeah. What's the monster under your bed? What keeps you up at night? Other than inflation, you don't get to say inflation.
Inflation?
No, you can't do that.
No, I would say this. We're at a place where the economy is strong, without question. The labor market's in a good place. We've got unemployment under 4% for more than 2 years now, for the longest time in 50 years, and we've had progress on inflation. So we want to use our tools in a way that keeps the strength in the economy and in the labor market, but allows for further progress in inflation. That's our focus. And we clearly have a chance at that outcome, and we're all very, very focused on doing everything we can to deliver that outcome. It would be a great outcome for the American people, and it would be testimony to how unusual the circumstances are.
Soft landing, transitory, words that I imagine you don't let be said in your presence very much. Here's another one that hasn't been said at a press conference that you've had since December: recession. Do you think a recession's off the table?
So there's always a sort of unconditional probability of a recession in the next year. And so the real question is, if you look through history, it's not possible to rule a recession out for a long period of time. So
granted, but you know what I meant, right?
Yeah. No. The real question is the possibility of a recession elevated at the current time? And I would say no. I don't see forecasters disagreeing with that. Growth is strong, as I mentioned. The economy's in a good place, and there's no reason to think the economy is in a recession or is at the edge of one. But humility.
Welcome to the Crypto Teacher. And I come back with that video just to make you think.
Don't forget to like and subscribe to the channel.
And make sure you're joining the Patrons. If you're not a part of the Patrons, make sure you're hitting the Cash App. And I don't know how much more evidence you need to know, but the Fed and Jerome Powell clearly are not going to be cutting rates. Guys, they're going to hold this thing high for longer until they're ready to pull off that crisis. Every report that we get, inflation is still coming in hot, and we clearly see this in the economy. Food prices are ridiculous. Doesn't matter whether you're going to the grocery store or whether you're going out to eat. But remember, the NWO calls the problem, wait for the reaction, and run in with the solution. And that's the reason why Jerome Powell keeps saying the economy is doing great. Inflation is not hurting anyone. He clearly stated that, while the consumer is being squeezed. And we know with these rates being high, it is going to destroy these small and medium-sized banks. The commercial property crisis is right around the corner. They let inflation get out of hand, so therefore they could raise rates. And they did it so fast because they know it takes 12 to 24 months in order to seep into the economy. Now that it's in the economy, they should be lowering rates, but they're not. Remember, we're in a fragmented world. They have to destroy everything in order for the fourth industrial revolution to rise. Whether robots, algorithms, and drones take the economy over, pay each other with crypto, and the sheep go inside the metaverse. And remember, the crypto teacher told you, because he knows. When it comes to the NWO, it's all planned out. You have a wonderful day.
Going to a different economy, and we're going to be learning more about that as we go. But clearly, we're learning that things can be done from remote locations. We're learning that technology can replace people even more than we thought.
We're not going back to the same economy. We're recovering, but to a different economy, and it'll be one that is more leveraged to technology. And I worry that that is going to make it even more difficult than it was for many workers.
In Silicon Valley, and my friends who work in technology know that what we did to the manufacturing workers, we are now going to do to the retail workers, the call center workers, the fast food workers, the truck drivers, and then even bookkeepers, accountants, insurance agents, lawyers, and on through the economy. So what happened to the manufacturing workers is a very clear sign.
And so we'll import Chinese-based CBDC technology. So it's going to be CBDC in a box provided to you by the People's Bank of China.
But every stock, every bond, every currency, every commodity, every piece of art, every private business, every piece of real estate will eventually be a token on a blockchain, an entry on a ledger, permanent and immutable. We will have truth instead of trust, and we will save over $7 trillion a year. 6 to 8% of global GDP is wasted by the friction of the trust industry that's necessary when you have dual entry accounting. With triple entry accounting, which is what a blockchain is, we get rid of all of that friction. It's a beautiful future.
Like what you see in China and their social credit scoring systems, right? If we get identity wrong, it could be a tool to enslave humanity. And if we get it right, it could be a tool to liberate humanity. And as an American, I'm obviously rooting for the one that's on the side of freedom.
Bitcoin is an international asset. And also, I do believe the role of crypto is, it's digitizing gold.
I actually believe this technology is going to be very important. Look at it. We have been part of a huge revolution in investing through ETFs. We believe that ETFs will be changing the whole way we invest. Many people still use it as a means, people are investing it for indexing. No, the majority of people who are putting money in in ETFs are active investors that are buying exposure. The entire bond market is being transformed as we talk right now. I believe the next generation for markets, the next generation for securities will be tokenization of securities. And if we could have that distributed ledger that we know every beneficial owner, every beneficial seller, we all have our code of who's buying, who's selling, instantaneous settlement. And think about it, it changes the whole ecosystem.
Chinese bank ICBC has been hit by a ransomware attack, and the U.S. Treasury market, as a result of that, has been disrupted. This, according to the Financial Times. We're getting more right now with Bloomberg's Shonali Bassick. Shonali, what do we know?
Listen, we have the Financial Times now reporting that ICBC, one of China's largest banks here, was hit with a ransomware attack. And remember, they're a very significant intermediary in the Treasury market. The SIFMA has told its members that this has been part of the reason here that the system is kind of clogged up, if you will, during that auction that we saw a little bit before. The attack had prevented ICBC, according to the Financial Times, from settling Treasury trades on behalf of other market participants. A large executive at a major bank also telling the paper that such a large party on the fixed income clearing corp creates major concerns, potentially impacting the liquidity of Treasury markets.
Now, it was not just a poor auction. It was absolutely lousy, and When the dealers have to step in to save a treasury auction, that's a rare occurrence. And very much a traditionalist. I like staying with the dollar. You know that from when I was there. It's make the dollar the choice. I hate when countries go off the dollar. I would not allow countries to go off the dollar, because when we lose that standard, that will be like losing a revolutionary war. That will be a hit to our country, just like losing a war. And we can't let that happen. And too many countries now are fighting to get off the dollar. And
Cryptoteacher and the New World Order book, plus the 3 kids books. It's time to re-educate. Also, new to cryptos, Coinbase, Bitrue, Binance. Do not forget book links and crypto links are in the description. The stock channel, guys. Don't forget to go like, subscribe, spread everywhere. You have your Kobo, your chip stocks, your banking, your gaming. While everybody's sitting at home, get home stocks, the Seaver, the biotech stocks. And while everybody's at home wishing they were still getting that free money, what are they doing? Drinking and smoking weed. Don't forget about those stocks, and you have a wonderful day. The most powerful person in the world is the storyteller. The storyteller sets the vision, values, and agenda of an entire generation to come. Steve Jobs. And guys, you know I truly believe in this. When you look at the New World Order, they're the storytellers. And that's the reason why I wrote my New World Order book. But guys, now it's time to change the current generation. And I wrote 3 kids books. You know I love the Trinity because I understand the power that's in it. So I have 3 books. We have an opportunity to change the generation, to educate, not just me, but I want to show you that I take action on a daily basis. And I want you to take action on a daily basis. Whether it's your job, whether it's in your community, we have an opportunity right now to educate the masses. I posted this on my Twitter account. Please share, but this is a short clip of the 3 books. There's going to be a clothing line and action figures. Please get these books for your kids, nephews, cousins, friends, so therefore we can start the re-education now. Because as we see, the 4th Industrial Revolution foundation is definitely here. Robots, algorithms, drones, taking humanity out the picture. We have to re-educate. But let's get into the video.
Part 1. King Joshua and Grandma Tam save the village. Part 2. King Joshua and Grandma Tam save New York from COVID 33. Part 3. King Joshua and Grandma Tam goes to China.
It's mandatory to get part 1, part 2, and part 3 of this series. It's time to re-educate Generation Z.